Welcome to the team. Seriously, I am absolutely thrilled to have you here for this explainer. Consider this your official day one orientation. Okay, let's dive into this because I really want to set the record straight right off the bat. A lot of people think our job is just, sitting in a back room somewhere, crunching numbers and ticking boxes. But the truth? The truth is we're in the business of bridging the trust gap. Our fundamental role is to literally stand between management and the shareholders, the lenders, the regulators, everyone who relies on financial data. We're there to make sure the information they are using to make massive million-dollar decisions is actually trustworthy. Now, there is a massive myth out there that we've got to debunk right now. It's this idea that auditors guarantee absolutely no fraud exists. Yeah, no, it's simply not true. Our job is about managing risk and protecting investors. It's not about guaranteeing absolute perfection. Remember, management is the one who actually prepares the financial statements. We just independently verify if those statements are materially correct. I mean, if we promise that every single fraud, no matter how tiny or cleverly hidden, would be caught, man, we'd be setting ourselves up for failure. We're here to provide a really high level of confidence, not a crystal ball. So here's our roadmap for today. We're going to hit 5 key areas. Number 1, the real mission. Number 2, reasonable versus absolute assurance. 3, the 2 types of independence. 4, the 5 independence threats. And finally, number 5, our vital safeguards. All right, let's kick things off with Section 1, the real audit mission. What exactly is an audit?
It's so crucial that you understand why we're called into a company in the first place. We aren't there to build their business. We're there to answer one massive question for the outside world: can we actually trust these numbers? And to fulfill that mission, you need a brand new golden rule: professional skepticism. I want you to think of this as disciplined doubt. Now, that doesn't mean you automatically distrust every single client you meet. Instead, it means keeping a relentlessly questioning mind. So when management hands you a pristine expense document, you evaluate it. You ask yourself, okay, is this evidence truly reliable, or is it just what they want me to see? Does their explanation actually line up with the paper trail? Is this transaction commercially logical, or could it be a vehicle for fraud? By constantly staying alert to bias, inconsistencies, and unreliable evidence, you ensure that the financials show a true and fair view without any manipulation.
Moving right along to Section 2, reasonable versus absolute assurance. So now that you've got your questioning mind ready, we really need to manage expectations about what that disciplined doubt actually produces. What kind of assurance are we actually equipped to provide out in the field? Well, this brilliantly illustrates the difference. We provide what's called reasonable assurance, not absolute assurance. Reasonable assurance is achievable. It's a really high but not complete level of confidence. It basically means we can confidently state the financials are materially correct. Absolute assurance, on the flip side, would be a 100% guarantee that no fraud or error exists whatsoever. And let me be totally clear here. Absolute assurance is simply not achievable. Why? Because to give a 100% guarantee, we literally have to verify every single transaction a global company makes, every single day of the year. It's just an impossible level of verification. To really hammer home why we can only offer reasonable assurance, let's look at the built-in limitations of an audit. First off, we rely on sampling. We test a representative slice of transactions, not 100% of them. Second, audit evidence is usually persuasive, not strictly conclusive. Third, and honestly this is a big one, fraud often involves active, clever collusion. People hide things, they forge documents, or they intentionally override their own internal controls to cover their tracks. Plus, accounting involves a lot of estimates. Try figuring out the exact value of a warehouse full of 5-year-old electronics. It requires a ton of subjective judgment. And finally, we're bound by strict time limits and cost-benefit constraints. We reduce risk to an acceptably low level, but we simply can't eliminate it entirely. Okay, on to Section 3, 2 types of independence. Listen, if you take away absolutely nothing else from today's explainer, remember this: your most valuable currency as an auditor is your independence. It's the absolute bedrock of public trust. And independence isn't just a state of mind. It actually has 2 distinct dimensions. First, you've got independence of mind. This is your actual mental objectivity. It's your ability to make professional judgments without being swayed by outside influences. But here's the kicker. Being mentally objective just isn't enough. The second dimension is independence in appearance. You have to also look completely independent to outsiders. Think about it. You might be the most honest person on the planet, but if the public finds out you own thousands of shares in the client you're auditing, no way. Their confidence in your report is completely destroyed. The trust gap widens right back up. Both types are absolutely mandatory.
Let's turn to Section 4, the 5 independence threats.
Now, what's really interesting about this is that out in the field, you aren't just facing math errors. You're walking into a literal ethical minefield. But thankfully, globally recognized ethical standards give us a framework to spot these dangers. I want you to treat this like your ultimate survival cheat sheet. These are the 5 threats that can compromise your independence. First is self-interest. That's when you stand to benefit financially, like owning stock in the client. Then there's self-review, which is auditing your own work. Advocacy happens when you accidentally become the client's cheerleader in a dispute. Familiarity kicks in when a long relationship makes you just a bit too sympathetic to management. And lastly, intimidation. That's the blunt force stuff, like a CEO threatening to cut your fees if you don't sign off on some really aggressive accounting. You've got to be able to spot these instantly.
I want to zero in on these self-review threats specifically, because honestly, it can totally sneak up on you. This is the danger of auditing your own work. Just imagine you helped a client design their internal financial systems, or you pitched in to help them prepare a specific set of accounts. If you then turn around and act as the independent auditor for those exact same accounts, yeah, your objectivity is instantly compromised. Human nature just dictates that you are way less likely to find faults in your own handiwork. Actually, scratch that. It's virtually impossible to be objective. You simply cannot grade your own homework in this profession.
Similarly, let's punch through the familiarity threat. This happens when the audit team and the client's management get, well, a little too comfortable with each other. If we leave the exact same audit partner on a client account for years and years, they become friends. They start giving management the benefit of the doubt instead of applying that disciplined doubt we talked about earlier. Your questioning mind just erodes. You stop asking the hard questions because you assume you already know these people and their intentions. And let me tell you, in our line of work, assumptions are incredibly dangerous. It's a massive threat to both your independence in mind and in appearance.
Which brings us to our final section, Section 5, Vital Safeguards. So what actually happens when we spot one of these dangers? Well, we don't just point them out and hope for the best. We take immediate, structured action to protect our integrity and the public interest. When a threat pops up, we implement these specific safeguards to knock the danger down to an acceptable level. To fight the familiarity threat, we rotate our partners. To fight self-review, we strictly decline non-audit advisory tasks. If we're facing intimidation or self-interest, we bring in a totally independent partner to review the work. And if the threat is just too severe, we walk away. We resign. So the crucial point here is that our independence is never, ever for sale.
Which brings me to my final and maybe most important question for you as you step into this new role. Are you ready to ask the hard questions? You are now armed with a real understanding of our true mission, the clear limits of the assurance we provide, and the ethical threats that are absolutely going to test your resolve out there. Your job isn't to just be a human calculator. It's to apply disciplined doubt, safeguard your independence, and make sure the public can actually trust the financial world. I am incredibly excited to see you put all of this into practice out in the field. Welcome aboard.